So to give you an example, if it's $1 million building, I'm sorry, $1,200,000 building, and the client or their accountant designates $200,000 for land, now I've got $1 million to work with. I will give that building owner about a $300,000 tax write-off the year he does the study.
Welcome. This is the Hot Real Estate Investing Podcast, a podcast dedicated to helping others through real estate investing. Our hosts interview guests from all aspects of real estate investing who generously share valuable experiences and advice. Whether you're starting out or an experienced investor, this is the show for you.
Hello and how's it going? My name is Travis Shelton and welcome to the Hot Real Estate Investing Podcast, where we focus on the mindset, motivation, and methodologies of successful real estate investors. And today we're going to talk about a methodologies all real estate investors should know about, and that's cost segregation. And today it's my pleasure to introduce cost segregation expert, Joe Viery. Joe, welcome.
Well, thank you, Travis. I appreciate being here. Thank you for asking me.
Yeah, absolutely. Well, would you mind giving our audience just a little bit more background on yourself, maybe your 30-second elevator pitch and your focus within real estate?
Yes, basically, in the year 2000, I segued from some businesses I owned into working for the California Association of Realtors. So I was helping them, their members and their members' clients with tax planning and investment strategies. And then you know what happened in 2007 and 8? The car went off the cliff, and the California Association of Realtors, that used to be like 150, 60,000 members, was cut less than half. So that ended that totally. Prior to that, I had a guy kept bugging me that wanted to talk to me about this strategy that he found out about and thought that I should know about. I kept blowing him off because I thought he wanted to sell me soap. So finally I said, okay, let's go to lunch. We went to lunch and he told me about accelerated depreciation or cost segregation. I had a couple clients that were staring down a $50,000 plus tax bill, and I was able to eliminate it and wipe out their tax bill. And then when the California Association of Realtors ceased to exist, the owner of the cost seg company said, why don't you come and work for me? You know what you're talking about. You know about, tax planning, blah, 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 blah. So I segued and I have not looked back. So I've been all the way up because my clients in the first days were I was lucky, were clients that had a lot of cash. So while everybody was suffering, they were buying notes and they were buying real estate. So I was busy from day one.
Oh, that's awesome. And definitely a good transition, I think, career-wise, personally, within getting within this kind of cost segregation expertise. And we typically start these podcasts with some motivation, but I don't know any better motivation than potentially saving millions of dollars in taxes. So we'll jump right into the focus, and that's really how can you help our audience of real estate investors? And so for someone that's maybe a little bit newer to real estate investing or hasn't heard of, accelerated depreciation or cost segregation before, what is cost segregation?
Cost segregation, I can give you the really quick elevator speech, and it's really simple.
Okay.
There is a practice in real estate ownership called depreciation, not to be confused with a depreciating building. I mean, it's basically the IRS saying that your building is falling apart or being used up over the life of the ownership. They've defined the life, though. The life for residential is 27 and a half years. The life for commercial is 39 years. So over this time period, the IRS is letting you take a deduction against your taxes because you're using up your building instead of waiting until you make repairs or, over time. And so you have a depreciation expense every year. The way that everybody in the past used to depreciate their building is called straight line. And that is dividing the building basis by 27 and a half years or 39 years. So you can see you're getting a little teeny expense, not really enough to get excited about. What we do as an engineering company, though, is we're taking the IRS rules and regulations and we're breaking out the building components into shorter life assets, 5 and 7 year for the interior of the building, 15 year for the exterior, the land improvements. And then we're always going to have the main chassis of the building, the windows, the roof, the doors, the foundation, etc. And that will stay in 27 and a half or 39 year property. So all we're doing is we're segregating out the shorter life assets But when you put those in a blender and spit them all out, what we're able to do is we're able to give the client about, if you want to just be very, very rough, about 30% of their building basis, they will be able to deduct the year they do the study. So to give you an example, if it's $1 million building, I'm sorry, $1.2 million building, and the client or their accountant designates $200,000 for land, now I've got $1 million to work with. I will give that building owner about a $300,000 tax write-off the year he does the study. That is a big tax write-off. If you have $300,000 in taxable income, I have now wiped out your taxable income. You owe no taxes.
Yeah, I mean,
So
it's amazing. It's huge. Yeah. So, I guess we're talking millions, maybe not everyone's there, but like who or what type of property owners should really consider it? I'm a multifamily investor and I do cost segregations on my assets, but let's say someone that's just doing a fix and flip or has a long-term rental, are cost segregation studies, valuable to those individuals as well? Or is there anyone that maybe it's not valuable for?
Well, here's what I do when I talk to people the first time. I want to find out a couple answers to a couple questions, so I'm not wasting their time and they're not wasting mine. So number one, I want to find out if they're a passive or an active investor.
Okay.
So passive and active just means is your main source of income. If your main source of income is coming from real estate and you're spending at least 750 hours per year, which isn't a lot, then you could be designated as an active real estate investor. Well, why would anybody care of active and passive? Because an active real estate investor, what the losses I give them can be used against all of their income, no matter where it's derived from. Now let's flip the coin and say you're a passive. What happened in the 1980s is that doctors were buying these dog buildings only for the depreciation expense. They weren't really worth anything except for the depreciation, and they were wiping out their income as doctors. And so the IRS and Congress said, no. Your main job is being a doctor. So here's what we're going to do. We're making it a passive activity, which means there's limitations. So that's why passive investors, if I'm giving them 300,000 and their limitation is 30,000 a year of the 300,000, I'm going to tell them don't do it.
Yeah.
Why would you bother? It's going to take you 10 years to use and get the benefit. So some passive investors go forward with us. A lot of them do, but again, they're for smaller investors. Somebody that owns a single family home. If I give a single family home, investor $30,000 in accelerated depreciation, and their maximum is 30,000, well, hell yes, you're going to do it. Yeah. So it just depends on a lot of factors. So that's one where it may not work. Yeah. Two might be a flipper, because there is a concept called depreciation recapture. And what that means is it's a tax when you sell your building for cash, not if you exchange a building and not if you die and it's inherited. But if you sell it for cash, depreciation recapture comes into play. So bottom line, flippers, I've worked with a lot of CFOs from developers in real estate companies, and I've kind of distilled it into Joe's thought process. And that is, as long as you're going to own the building for 1.5 years to 2 years, I will tell you to do cost seg and accelerate the depreciation. However, if you're a flipper and you're going to buy a building and sell it, it's not, you're not going to get hurt that much, but why bother? Because you're just going to have to pay it back. So if you're a flipper, I will tell you, you might want to look at 45L energy studies, tax credits, but don't do cost segregation. And then the third one that may be a factor that where I might say no is if you're doing a 1031 exchange. If you're doing the normal 1031 exchange, and I'll give you an example. You sell a building for $1 million, you buy a new building for $2 million. Guess what? I've got $1 million to work with. I will tell you to move forward. But let's say you sell the building for $1 million and you buy one for $1 million or 1.1 million. I have nothing to work with, because the building that you sold, the relinquished building, whatever method you use, which is going to be straight line, is frozen in straight line forever. I can never accelerate it. So sometimes if you do a 1031 exchange, I might tell that client, don't bother doing cost seg. So I do a call with my clients just to let them know that most of the time I can help them. But if I can't help you, there's no reason to go forward with the conversation.
So a couple of interesting things I wanted to unpack a little bit there. So on the 1031 exchange, what you're saying is if on the initial property, if there was straight line depreciation and you don't necessarily double or have a big enough difference between what you're selling and what you're buying, then it's unlikely that the cost segregation is going to benefit you much because the original property was on the straight line depreciation.
Yep. That's
Okay,
going to be an even 1031 exchange. There's nothing for me to accelerate. Now,
gotcha.
there are little tricks. You should call me and talk to me because there are tricks. So, for example, if you have not filed taxes on the building you sold and
Hmm.
you have access and I can do the cost segregation on the building you sold, like the
Ah,
owner,
yeah,
the new owner of the building will let me have access to the building, we could preserve it. We could go in there and do the cost seg and accelerate that building. So it might be worth it. But that's kind of rare. So
yeah.
usually when it's a 1031 exchange and if it's an even exchange, then usually the answer is no.
Okay. And then I guess on those situations like the doctor that buys it and let's say they can depreciate 300,000 but they can only use 30,000 a year. Now that 270 like it obviously carries over year to year to year. Now, can that be used for tax savings I guess when they sell the property? Let's say they choose not to do a 1031 but they had, $100,000 worth of profit. Is that carryover is allowed to be then written off from the taxes that they would owe based on the
Yep.
capital gains, basically, right? Okay.
And you talked on a great topic there. You're talking about a great topic. And that is that we can go back 15 years. And a lot of people
Okay.
don't know that we can go back 15 years and do cost seg. Now, what do I mean? It's not 15-year-old building. It's 15-year-old when you purchase the building. So
Mm,
we can go back about 15 years and make the numbers work. If you go back further than that, then the calculations just don't hold. And so you're going to pay me money. I'm not going to give you that much value. So I'll be the first to tell you don't do it. So
yeah.
bottom line is, you are correct in that you can go back and do cost segregation and you can get those tax deductions. There's a little bit more complex because
Hmm.
I have to do additional calculations, so the fee's going to be a little bit more. But in that case, on look back studies, yeah, we can provide a lot of value.
Yeah, I think it's such a great point. I think so many people think that they like lost the like missed the boat on cost segregation, right? And even myself, I bought a property, I kind of planned to flip it. So I didn't do a cost segregation up front. My CPA was like, "You should really do that if you're going to hold it." I was like, "No, the plan's going to sell it." Ultimately, the market went bad, interest rates went up, so I said, "You know what? I'm going to hold this." So I ended up doing a cost segregation like 2 years later, accelerating depreciation, and now we're holding that asset. And even if we go to sell it, we're still better off now having done the cost segregation and having to pay any kind of recapture. But great point. I think all investors out there, anyone listening, is like, hey, if you've had a property for a couple years and you haven't done a cost segregation, now is still a great time to do a cost segregation and really be able to accelerate those losses. So thanks for kind of bringing that up, Joe.
And
Um,
here's the
yeah.
answer your one question real quickly, though, is that you don't get burned by doing cost segregation because you're right. Meaning that if I had 270,000 or so I consider it like a bank account. I give you
Yeah.
$300,000 in extra depreciation, and you're only limited by X. Let's say you're limited because you don't need $300,000 this year. You only needed 150. Well, now you have 150 in your depreciation bank, and that'll carry forward until you use that all up. How long? I say indefinitely. Is it
Mhm.
indefinitely? No, but it's like 15 years down the road. Nobody owns properties for 15 years. Well, maybe
So-
three people, but very few people own properties for that long. So bottom line is, even if you were forced to sell the property, like somebody gave you a boatload of money, it's
Mhm.
just that you're not going to have a lot of time because what we're doing is based on the principle of the time value of money. So
Yeah.
yeah, let's say that you sell the property, the extra depreciation will go against your capital gains. So you're not
Mhm.
going to get hurt. It's just
Yeah.
not going to be as powerful as if you were going to be able to save, 200,000 in taxes so you can buy more property. Well, that's a different story. If you're limited to 30,000 a year, you're not
Yeah.
going to have all that much money. It's going to take you 10 years to go through the bucket. But you're never going to get burned by doing cost seg.
Yeah, so I mean, all positive. I guess what are the negatives? Like we talked a little bit about recapture. I know that sometimes people think that's a negative, which I think you just kind of emphasized how it's
Well, no,
not
I
a
got to talk. I
negative.
got I got to
Yeah.
interrupt you and talk about
Yeah.
that.
Okay.
Here's the caveat. Cost segregation, if you have an expert and your accountant is an expert that knows how to use cost segregation, reduces depreciation recapture.
Okay.
That's right. Now, why is that, Joe? I'll tell you why. Let's look at the example of a laptop. You bought a laptop 5 years ago for $2,000. 5 years later, what's that laptop worth?
Nothing.
50,
Yeah.
70, 100 for parts because
Yeah.
it's obsolete. No one's going to buy the thing except for parts. So we tell are the accounts. I'm not an accountant, by the way. I don't give accounting advice or tax or legal advice.
Okay.
But I will tell you what our savvy accountants will tell the IRS. Okay, 5 years ago, the client bought the property. 5 years later, what's the 5-year property worth? Same concept. It's worth 1%, 2%, 3%, 4%. You're going to have to give a value unless you get really greedy and say it's worth zero, which I wouldn't do. You got to tell the IRS it's worth something. What about the 15-year property? 1/3 of the 15-year property comes off the table. So what have we done? We've taken a big chunk of your depreciation recapture and we've reduced it by taking away the 5 and the 15-year property, all that's used up during the time that you've owned the property. To make the example easy, I said 5 years. Yep. But it makes no difference. If you own the property 3 years, you're just going to take 3 years off the 5 years and take that off depreciation recapture. So that's a very highbrow concept that you don't have to know about, but you should take it back to your accountant and say, hey, look, Joe Viery told me about this. Yeah. What do you think? And if he has a question, call me. I don't charge.
Nice. So what are the downfalls? Like, is cost a limiting factor? Like, what is a limiting factor? Or like, why doesn't everybody, like, why don't you buy a home and immediately every cost segregation person reach out to you to have a cost segregation? Does this help a normal family and a normal single family home? I mean, like, what is the negative? And maybe what's a general cost of one of these situations? I know a big multifamily, couple hundred units versus a single family home, there's going to be variances there, but maybe ballpark for the audience just so that they're aware.
Okay, so here's how we work. We use the document that's printed on the web. You can find it. It's called the Audit Technique Guidelines for Cost Segregation, or ATGs for Cost Segregation. It's published by the IRS to tell their agents what they need to look at when they audit cost segregation. That's my Bible. So we play by the Bible. We play by the book. And so bottom line is there aren't that many reasons why somebody would not do cost seg. I've already explained the reasons.
Yeah, all positive. Yep.
Oh yeah. No basis on an exchange. You're not paying income taxes. Everybody else should be doing cost seg. You know one of the other reasons why? Because what we do in a cost seg report, a quality cost seg report, is we're breaking out all of the items that made up the building, all the components. So now, let's say 3 years down the road, you decide to replace the roof. Well, the IRS does not want 2 roofs on the depreciation schedule. You have one roof that was baked into the acquisition cost. That's what we do as engineers. We break out all of the components of the building. You have the new roof. You ripped off the old roof and you threw it in the trash, and now you put it on a new roof. Well, so you've got a new roof and you've got an old roof. The IRS does not want that. So what do you need to do? You need to write off the old roof. Well, I've given you the calculations for what the old roof cost. So now all you have to do is use my calculations to make a deduction. And who doesn't like deductions? So that's another reason to do cost segregation. Now you've got the roadmap. If you have a quality study, I've seen competitor studies out there that don't give the breakout that we do. We give very fine, detailed breakouts. So I can't talk about every cost seg study out there. So that's one reason why. Another reason why you want to do cost segregation is to do write-offs. You throw away the HVAC system. Guess what? That's a write-off.
Yeah. And you just add the new HVAC system. Yep. So is this is this like a red flag for IRS auditors? Like, do people that do cost segregations, do they get audited more frequently, less frequently? Do you have any stats on that?
Yeah, well, yeah. When I first started in 2007, that was the number one comment question. Oh, this must be a scam. You're going to save me $50,000. No way. This is a scam. So I'd have to go through IRS rules and regulations, the ATG guidelines, and show them and print it out and give it to them to read. Nowadays, if your accountant does not know what cost segregation is, look for a new accountant.
I was going to say,
Because
yeah, you got the wrong accountant.
everybody, now they may not be able to do it, and they
Yeah.
shouldn't, because you need an engineer to do it. And so one of the red flags is know who you're working with. Because
Okay.
if your accountant says they can do cost seg, if you get audited and you do it or your accountant does it, you will have no chance. The IRS engineers are really, really good. I defend mine at no extra cost. I will answer their questions because we do everything by the book. So why wouldn't I?
Yeah.
So that's one of the risks. If you're using somebody else or you're trying to do it on your own, then and you get audited, you probably need to call me to bail you out.
And I guess in general, what should investors be looking for when they're looking for a cost segregation company? To your point, they're not all created equally. Is it someone with an engineer on their team? Is it, like when they're evaluating different companies, let's say yours versus a couple others, like what are some of the factors they should be evaluating?
Yeah, again, experience, engineering competency.
Mm-hmm.
And the one that I really like is what I already told you is what do they base their business model on? They better say they base it on the audit technique guidelines, because that document, the judge who made the IRS explain this to the world, told the IRS they must print the they didn't call it audit technique guidelines, but they said you must print this because we want the taxpayers and their accountants to know all about cost seg. So if somebody is not using the audit technique guidelines and now they're taking shortcuts, and for example, a shortcut would be, oh, we don't need to go out and look at the property. We can do everything, we can do everything without looking at the property and measuring everything. Well, that's not going to fly. Now, it does depend on the building. So
Okay.
I will tell you that for smaller buildings, we do not go out and measure everything. We do everything virtually.
Okay.
We take the information we get from the client and we can do everything only on small buildings. If it's a bigger building over basis 750, we need to go out and measure everything because we want to be compliant. So
Okay.
we call that study a modeling study, and they get back on your prices. And this is what a lot of investors don't understand. So we can do a building with a basis of 750,000 or less. If it's a current tax year modeling study, analytical study, we charge $625.
Okay.
If it's a look back study, we charge $50 more because we have to do all the calculations, $675. And so is it worth it for every building owner? Yeah.
Absolutely. Yeah. I was
It's
going to
not
say,
like
do
the
you have
old
an
days where
average
these
of
were
what you can
thousands.
save year one? Like what your clients typically save year one?
Oh, it depends on the building.
Yeah.
It's so like right now, tell me what the average single family home cost in the United States.
I mean, probably 400, 500,000, right?
Yeah. See, in my day, I've been doing this for so long, people were buying buildings for 30, 40, 50,000 back 7 years ago. Well,
Yeah.
those days are long gone. So let's say the average is 300,000. And just to make the math, let's say 400,000. And let's
Okay.
say to make the math easy, 100,000 is allocated to the building. I'm giving them, they have a $300,000 building basis, and I'm going to give them a $75,000 tax write-off. And I'm going to charge them $625. So you do the value proposition. Is it worth spending $625 to get a $75,000 tax write-off? If the
All day,
answer
every
is
day.
no,
Yeah.
then you should invest your money in something else, maybe crypto.
Yeah. There's not so many tax savings in the crypto world, huh? You
No.
definitely can't do a cost segregation. Yeah. I mean, I think
Now,
this is one of those things. Go ahead.
let me interrupt you for one sec. So on the detailed engineering, since we do everything correctly, we must look at the building before I can give you a fee.
Okay.
I will tell you though, even for detailed engineering, our fee structure, because of our automation, is really affordable. But it's not like the good old days when we were charging $30,000, $40,000, $50,000. I mean, I just did a quote on a $18 million apartment building, and our fee was 12 grand. Well, do you know what we saved them on an $18 million apartment complex? If you took off 20% for land, and I'm just, going to give you like $14 million in building basis, and now we gave them 30% of $14 million.
Yeah.
And you paid me $12,000.
Yeah.
Oh, come on, man. That's like hundreds of over the 12,000. And by the way, the $12,000 is a tax write-off.
Yeah. I was going to say then
Yeah.
segregation for anyone is really a tax write-off. So you're basically getting another tax advantage by doing it, plus the huge savings you get by the actual study. So really a no-brainer. I guess my next question is, it's end of March when we're recording this. We're right around tax season. Like, how quick can you get one of these studies completed? From like the time I say, hey Joe, I want to get this done on one of my properties, until I have the report in my hand and can give it to my CPA. What's an average time length?
30 days after we get all the information.
Okay.
And why I say that is because some clients just really, they hate getting the information together, and we
Yeah.
don't make stuff up. So I got to get your closing statement. I
Yeah.
have to get, if you did any improvements, I have to get cost details. What did you spend your money on? I don't make it up. So you have to tell me what you did. I pretty much know what you did, but you have to
Yeah.
give me the backup, and then
Yeah.
I can break it down and I can do the acceleration on what you give me. We look at building plans if you have them. It's kind of rare nowadays to get building plans. It's kind of tough.
Yeah.
And then if it needs to be inspected, we have to go out and inspect the building. So 30 days from when I get all the information and we get the building inspected is when I can turn this around. If we need to do a miracle and move mountains, we will do the best we can. We have turned projects around within a matter of a week to 10 days. But boy, the stars have to align to
Sure.
pull that off. So I tell everybody, plan ahead.
Yeah.
But nowadays it's not that bad, because if you need a cost seg, just go on extension. And your extension deadlines are September 15th and October 15th.
Absolutely.
And it doesn't cost you much to go on extension.
And I think this is one of those things all investors should be thinking about, and everyone on the podcast listening, is probably an investor. So it's do this as part of your due diligence. I mean, you should be thinking about this before you buy the property, and you should be getting this done pretty much the day you buy the property.
There's good reason for that.
Yeah.
Because we need to see the property before you go in and start ripping stuff out.
Yeah.
I mean, it doesn't do me any good after you've thrown everything away and then you go, oh, I want the dispositions calculated. Well, what did you throw away? No. So the best way is for us to go out immediately, do the first phase, and then as you start doing the improvements at the very end, we'll come back and we can calculate what we threw away, because we saw it before you threw everything out.
Yeah. And you have the exact cost of everything you actually use to improve. So then it's a much better kind of dollar by dollar basis. So what have I missed, Joe? What questions did I not ask you that you'd like our audience to know maybe a little bit more about cost segregation, or did we cover it all?
You know what? I think for the first 10,000 foot view level, we did a really good job. I think that what everyone should take away from this is just we don't charge for the first round it's a no cost estimate. Just get the estimate and go to your accountant and say, look, does this make sense for me? If the accountant says no, I don't argue. I agree. Sure. If the accountant says no, the answer is no. But I would at least get the estimate, because I tell you, there's very few times where it doesn't make sense. And I want you, if I did save you X amount, like let's say $200,000, what do I want you to do? I want you to buy more real estate.
Yeah.
I want you to improve your properties. So who wouldn't be excited to do that?
Yeah. I mean, I think everybody wins in these sorts of situations, and I think that's what every investor is looking for, are some win-win opportunities. Well, I appreciate it. I've learned a lot myself, but now are you ready for the hot seat?
Yes. Ow.
All right, let's do it. We ask all our guests the same final 4 hot questions, and so Joe, number 1, what is one book you'd recommend to someone wanting to know more about real estate investing?
Well, I defer to one book that really had its impact on me when I was in college. I was a business management major. And what it is Think and Grow Rich.
Oh,
and it's not really a real estate book per se, but my word, if anybody is starting out in life, I always tell them, read the book, because if you can, there's so many concepts in that book, which I'm going to continue on one of your other questions, but there's so many concepts in that book, like Think Group. You want to surround yourself by people like Travis, who know their stuff. And that is so valuable when you start off.
Well, I appreciate that. And great book. Yeah, I love Think and Grow Rich. I definitely think almost anyone in the world should be reading that book. So question 2, what's your favorite productivity tip, trick, tool, maybe a time saver, an app that allows you to get more done than the average person?
Okay, this is like I said, remember the think group?
Mm-hmm.
Surround yourself by people who know what the hell they're talking about. You don't want an accountant who works for people who work for Costco.
Yeah,
They're great accountants. I admit that. I love those accountants, but you want an accountant that knows real estate because we're
absolutely.
talking about one small sliver. There are so many advantages in real estate. You want somebody who can tweak all the advantages so that you definitely are not going to pay income taxes and it's going to reduce your capital gains. So whether it's an attorney, whether it's an accountant, whether it's a marketing professional, whether it's a Travis, surround yourself by professionals. Do they cost money? Yeah, but they're going to save you a lot more money than they cost.
Absolutely. I mean, I think that's one of the biggest short-sightedness of anything within real estate investing and just investing as in general is what I hear all the time is they didn't use the right person off and it costs them so much more money. So it's such great advice to use the right professionals up front as opposed to on the backside because you do save a lot more money. Joe, what's the biggest real estate mistake or failure you've made and what did you learn from that experience?
Well, you know what? Since I am not in actual real estate ownership, I
Mm-hmm.
own real estate, but I'm not a big investor.
Mm-hmm.
So that's a really tough question for me. But
Okay.
I think again, it goes back to getting the right advisors on your team.
Mm-hmm.
That's probably, like we said, that's probably the biggest mistake that
Yeah.
I think anybody could make. And that really will come back and haunt you. Like if you pick the wrong cost ed company and you get audited and they're nowhere to be found. And I've heard these stories where,
I'm sure.
they just say, oh, I'm not going to defend our work. You're going to be in trouble. So
Mm-hmm.
that's my advice.
Great. And then last question, if you could be remembered for one thing, what would it be?
Great. We did it the right way.
Yeah.
We did it the right way. We followed the IRS guidelines and you know what? I hate to say this, but my company has only been, well, kind of a funny thing. I was going to say once, but the reason the one client got audited was because they took my report and changed it.
Oh, great. Yeah.
And then they asked me to defend it and I helped them to as much as I could without lying to the IRS. But
Yeah.
bottom line is, um, that's one thing that we would not do is we've just not been audited. So,
Yeah.
we're very fortunate because we do things the right way.
That's awesome.
Yep.
Well, the best place for the Hot REI community to connect with Joe is going to be at USTAGI.com, which stands for U.S. Tax Advisors Group, Inc. I'll include that website on the show notes. And please, if you have more questions about cost segregation, please schedule a call with Joe. He's a wealth of knowledge. Joe, this was a lot of fun. Again, I learned a ton. I really appreciate you being on the show today.
Excellent. And I enjoyed the show. You did a good job. Thanks, Travis.
I appreciate it. To the listeners, check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review so we can continue to bring even more value to others through real estate investing. And as always, commit to taking action today to move your real estate investing forward. Take care and God bless.
Thank you for listening to the Hot Real Estate Investing Podcast. Check out our website, hotrei.com, for additional content and resources. And please take a moment to subscribe and leave a review so we can continue to bring even more value to others through real estate investing.